capital markets, of course, rest on a very simple promise: fair information, honest price discovery, and a level playing field. Upholding that promise is the role of the capital markets regulator, the Securities and Exchange Board of India. And right now, the agenda is as complex as ever, from the surge in retail F&O trading to IPO pricing and global capital flows, and of course, the impact of the war. Ladies and gentlemen, we are privileged to have among us today the man holding it all together, a beacon of stability in a world full of chaos, the chairman of SEBI, Mr. Tuhin Kanta Pandey. Sir, we at Moneycontrol are very fortunate that you kicked off the inaugural Global Wealth Summit last year in your first public speech after taking over as SEBI chairman. And we're delighted that you're back this year at the second edition, sir. We are very honored and grateful, sir, for your presence. Ladies and gentlemen, Mr. Pandey has been India's one of the most distinguished civil servants, an IAS officer of the Odisha Cadre of 1987. Before joining SEBI, he served as the Union Finance Secretary, the Revenue Secretary, and the Secretary Department of Investment and Public Asset Management, also the Department of Public Enterprises and DOPT. He's also served in the Regional Office of the UN Industrial Development Organization and holds a master's degree, sir, from Chandigarh University and also from an MBA from the University of Birmingham. Sir, over to you, sir. Everyone is waiting for you.
Good morning, everyone. It's a pleasure to be here today with this distinguished gathering of leaders from finance, business, policymakers, media, and the wider ecosystem. I would like to thank Moneycontrol for bringing together such a diverse gathering of participants. Today's theme, making capital markets more efficient in uncertain times, is both timely and important. If we look at the global economic landscape today, one word appears repeatedly: uncertainty. Technological change, particularly the rise of artificial intelligence, is reshaping industries and business models across the spectrum. At the same time, geopolitical tensions continue to influence economic relationships. Conflict in Middle East has massively disrupted energy supplies and created volatility in oil and gas markets across the world. Inevitably, capital markets have been severely impacted. Yet, when we look back at similar episodes in the past, one lesson becomes clear: periods of extreme volatility never last forever. In the recent past, we have witnessed the disruptions caused by COVID-19 pandemic, followed by the Russian-Ukraine conflict, which had triggered market volatility across the world. Markets experienced turbulence, but they eventually stabilized. Even today, while the ongoing tensions in parts of the world have created uncertainty in energy markets, global efforts are underway to restore stability. For many investors, especially retail investors, the best strategy may be, during such period of high uncertainty, to remain patient. Markets today operate in a very different information environment. Capital flows now respond not only to economic fundamentals, but also to rapid shifts in sentiment, information, and narratives. This raises an important question. Can markets remain efficient when uncertainty itself becomes the norm? Or perhaps a more relevant question is this: are markets designed to function efficiently despite uncertainty? Because uncertainty, as history tells us, is not an exception in financial markets. It's a recurring feature. The real test of a market is not whether volatility appears. The real test is whether the system continues to function smoothly, fairly, and efficiently when it does. Efficient capital markets play a stabilizing role in an uncertain world. They enable transparent price discovery. They help absorb shocks without destabilizing the broader financial system. And perhaps most importantly, they sustain investor confidence. Efficiency is the foundation of trust in the financial system. Without that trust, capital hesitates, investment slows, and growth becomes more difficult to sustain. In fact, the true test of efficiency is not in theory, but in how markets evolve and perform over time. India's experience over the past decade offers a compelling illustration of this evolution. India's capital markets have expanded significantly over the last decade. Since FY15, our market capitalization has grown at a CAGR of about 15%. The corporate bond market has expanded steadily at a CAGR of around 12%. The primary market has remained an important channel for capital formation, facilitating around 9.7 trillion rupees of capital raising annually. The number of unique investors in securities market has grown at roughly 21% CAGR, indicating a broadening investor base and a rising household participation. Mutual fund AUM have expanded at over 20% CAGR. The AIF ecosystem has witnessed rapid expansion, with investments growing at more than 50% CAGR, channeling capital into startups, innovation, and emerging sectors, and so on. These numbers tell an important story. India's capital markets are no longer merely expanding. They are deepening, diversifying, and becoming increasingly resilient. But as markets grow in scale and complexity, they also become more closely connected to global developments. And that brings us to the changing landscape in which today's market operates. The environment in which our markets function is evolving rapidly. One important shift is economic fragmentation. Trade corridors are changing, supply chains are being restructured, and investment flows are responding to these shifts. Another major transformation is driven by technology. Algorithmic trading, artificial intelligence, and advanced data analytics are accelerating the speed at which markets operate. Liquidity conditions are also becoming more episodic. Global capital flows can move quickly across geographies. But perhaps the most striking change is the velocity of information. News travels quickly, opinions travel even faster, and most importantly, markets today react almost instantly to the narratives. And therefore, the question before policymakers and market participants alike is, how do we ensure that speed does not compromise stability? In recent years, SEBI has undertaken a number of initiatives to strengthen the efficiency of markets ecosystem. We have reduced the settlement cycle to lower the settlement risk and improve operational efficiency across the market. To strengthen debt ecosystem, thresholds from electronic book mechanism have been reduced and the scope of EBP platforms has been extended to include REITs and InvITs. In a measure aimed at further facilitating capital raising and easing minimum public offer requirements for larger issuers, the central government just yesterday notified changes to SCR rules. These changes allow companies to list with different levels of initial public float, consistent with adequate liquidity, and provide a longer phased timeline to achieve minimum public shareholding requirement of 25%. We have strengthened the AIF ecosystem with lower thresholds for LVFs, large value funds, and strengthened the framework for accredited investors. For global investors, our effort has been to make access simpler and more seamless. Measures such as simpler regulations for IGB-only funds, introduction of common contract note, Swagat FI framework, relaxed block windows, all are aimed at enhancing ease of doing business and bringing in operational efficiency. Another area of our focus is how can we increase investor participation. To improve the investor access in debt market, we have reduced the investment threshold for privately placed bonds. Issuers are permitted to offer incentives in public issues of debt securities. To promote greater participation in mutual funds, distributor incentive structures have been revised. For NRIs, certain KYC requirements have been eased, facilitating smoother participation in Indian markets. Our efforts are underway to further simplify the investor onboarding processes by enabling enhanced information sharing through KRAs. While expanding participation, investor protection remains central to the regulatory framework. Tools such as validated UPI handles and SEBI check enable investors to verify intermediary accounts in less than 30 seconds before making payments. Monitoring of social media platforms help identify misleading or manipulative content. Initiatives such as Parva are helping standardize and verify performance data presented by intermediaries. With an aim to strengthen the governance standards and accountability across the ecosystem, we have taken several measures like mandating external independent performance evaluation for our market infrastructure institutions, designating compliance officer in regulated entities as key managerial personnel, strong emphasis on independence, diversity, and accountability in board composition, mandate for regulated entities to dissociate from unregulated entities that make unverified claims on returns on performance. These efforts aim to ensure that market development remains anchored in transparency, accountability, and investor trust. However, efficient markets cannot be built by regulation alone. They require the collective commitment of the entire ecosystem. Listed companies must uphold high standards of governance and disclosure. Intermediaries must promote a culture of compliance and integrity. Institutional investors must contribute to responsible market development. And market infrastructure institutions must continue strengthening resilience and operational excellence. Efficient markets are, in essence, a shared responsibility. As India continues its economic journey, capital markets will play an even more important role. The next phase of development will require deeper bond markets, stronger institutional participation, and continued technological innovation. Today, capital markets are moving from supporting economic growth to shaping economic growth. Ensuring that this growth remains transparent, resilient, and efficient will be one of our most important collective tasks. Let me conclude with one final thought. In uncertain times, the strength of a capital market does not lie in the absence of volatility. Volatility is a natural feature of markets. The real strength lies in the confidence that the system will function fairly, transparently, and efficiently, even during periods of stress. If we continue to strengthen our institutions, deepen participation, and uphold governance, India's capital markets will not only navigate uncertainty, they will emerge stronger from it. And that is a journey we must pursue together. Thank you. Jai Hind.